Welcome to the Professional Investment Podcast. I'm Charlotte Moore, award-winning journalist and founder of Moore Square Communications. Each episode, we welcome a guest to the show to share their news story of the week. And I'm delighted to welcome Iain Campbell, Head of LGPS Investment at Hymans Robertson. Welcome, Iain.
Great to be on the show.
Lovely to have you. And lovely to have you on the final episode of the first series. Now, do share with us, what is your news story of the week?
So mine is that most pension funds have net zero commitments, but challenges persist, PLSA says, from the 4th of December.
Yes, and that was published in Professional Pensions. Do tell us, Iain, what is it about this news story that caught your attention?
So I work with the LGPS. That's what I love to do. And this story is really applicable to the LGPS and discusses an issue I find myself tackling on a regular basis. So the LGPS have been early adopters of net zero ambitions, being pioneers, paving the way for other investors to follow and learn from. Really driven by their super long timeframes for investment, meaning they will still be investing when the worst of climate change effects hit us, if not enough is done. So they really need to take this seriously. And this pioneering is done despite the significant challenges that this story mentions in setting a strategy for delivering net zero. And whilst there are lots of challenges, the article talks about, I think really the key challenge is no one knows what a net zero investment strategy that delivers the level of returns that LGPS funds need looks like. So you're setting an ambition that you don't really know how you're going to achieve. And this has really led funds to take one of two roads. Some have decided to set ambitions anyway, deciding that having the ambition will motivate them to take action on what they can now and to look for further solutions that develop in the future and ultimately drive demand for those to be developed. Whereas others decided that it isn't worth setting an ambition for something that you don't know how you're going to achieve. But what's really important there, because it's a perfectly sensible view to take, but you need to make sure that that lack of a net zero ambition doesn't stop you from taking action on climate change risk and opportunities, because you can still, of course, take action without a net zero date.
Yeah, and as you say, the LGPS have been at the head of the curve on this. The lessons that other investors can learn from them. Can we talk a bit about there's ambitions and there's actually achieving your goals? It's one thing to set a net zero target, but actually getting there is a different matter.
Yeah, absolutely. So I'd say when funds set ambitions, they typically also agree some shorter term targets to get them on the way. So this could be reducing the carbon footprint, investing in more in kind of green companies or companies that provide solutions to climate change. This can be quite simple, such as moving your passive funds into climate tilted versions. However, many funds are now looking beyond this. So many initially set their targets 3 or 4 years ago around kind of the actuarial valuation date in England and Wales. And I'd say a lot of actions were taken then, but now we're hitting kind of a 3-year review point that many funds are now completely reconsidering it, basing it on the new information that's available. So we have found at Hymans that a climate transition action plan is a great way to tackle those net zero ambitions, turn them into actionable plans to achieve that ambition and to inform all the decisions that you make. So I say these have helped to lead to clients making some new investments that were really helpful both for the world, but also their own portfolios. So we did undertake this with a fund with a really ambitious net zero date a few years ago, and they're now in the process of implementing a lot of these changes. So I'd say we've moved beyond that, just removing of high emitting companies from equity portfolios that many did in the first place, because ultimately, whilst they will reduce the carbon footprint in your own portfolio, it won't necessarily take those emissions out of the real world. If enough funds do it, fair enough, it might cause companies like Shell to change, to take greater action to cut those emissions. But if not, then ultimately you'll just end up with a position where, say, the LGPS or other like-minded investors as a whole have really low carbon footprints, but actually the real world isn't moving towards a net zero place, because ultimately those companies are now owned by potentially less responsible investors. So they're just doing what they were going to do anyway.
Yeah, I think that's a really interesting point. And I wanted to kind of explore that with you because, as you say, you can kind of be very, very rigid about your net zero targets and you can clean up your own portfolio to the point that it does look perfect. But it's not sure that that perfect is actually going to deliver what you need. And sometimes you have to get your hands dirty and you have to go brown in order to go green. So could you talk to us about those lessons that have been learned and some specific examples of what the LGPS is investing in now that's going to bring around real world change than, say, for example, just virtue signaling?
So I'd say a lot of funds now are turning to their private markets assets that have probably been the more difficult places to do. So you're looking a lot more at property, whether it's commercial or residential, and trying to convert buildings to be greener to help manage down those costs. I think that's a big help rather than just investing in a fund which builds new green buildings. Instead, it's converting what we already have, which I think is better for the world. We've seen a lot of funds invest more in renewable energy infrastructure. So that's not a new investment for the LGPS. They've been investing in it for many years. I think initially driven by the strong returns that were on offer when government were offering quite generous subsidies. But I think the interest is still growing there. We're seeing a number of funds have a greater willingness to invest in say, newer technologies and solutions, which then has that real world impact because that energy is now being produced without the emissions. So you're avoiding energy being produced by, say, coal power plants or other fossil fuels. And then I'd say the final big trend in the LGPS at the minute is investing in forestry or timberland. Particularly where the biomass of those forests increases over time. So that's trapping more carbon. And importantly as well, that the products from those forests are being used in a sustainable way. So the wood that's being used is used in buildings or furniture where the carbon inside will be trapped for a long time, not just burnt in a energy plant, which just puts the carbon straight back out into the atmosphere. So we've seen a number of funds invest here, and a group of LGPS funds a year or two ago actually helping to launch a new fund that does exactly this and actually creates carbon credits. And this has led to pools seeing that demand and starting to launch products in this area themselves.
Well, that's very interesting. I mean, one of the things you haven't touched on there, it seems very much sort of like taking quite an activist approach through the private assets and also through a new asset class through timberland. But is there much debate going on about stewardship as well? Because these companies, I mean, the LGPS, they still have active equity holdings, so you can do quite a lot of stewardship there. That's kind of easier in a way than it is for passive, but they also have passive holdings too, and that is perhaps the ultimate investing brand to go green, and that you just hold a basket of the world's economy stocks. So is that an area they're also looking at? Because to my mind, it's a two-pronged approach.
Yeah, exactly. It's a great example again of the development we've seen over the last few years and the LGPS's approach. So I'd say with the setting of the net zero ambitions 3 or 4 years ago, we saw a lot of carbon footprints be taken where funds were looking at their portfolios and saying, well, what do I have? How is it positioned now? Where are the problem stocks? And actually in that case, we found a lot of active equity funds with just a few small holdings that were the vast majority of the carbon footprint of the portfolio. And then we were able to take that and challenge the managers on this and really give them a bit of a kick up the backside. I think in all of the ones that I worked on, when we challenged those tiny positions with huge carbon footprints, the managers agreed to sell them without much of a fight, which is great. But why were they investing in them with them in the first place? So then that was the challenge of speaking to managers and saying, are you really taking this climate risk seriously? That's probably developed now. I think that's a lot of good's been done from that, and now LGPS is focusing instead on the stewardship of the underlying companies. So being far better and far more active at projecting the voice they have to make the companies change themselves. So there's a lot of divestment campaigners targeting LGPS around the vast majority of issues. And the answer back is always, well, it's better to engage, to change these companies. That's how you'll create change in the world. But ultimately they want to see evidence that that's actually having an impact. So we're seeing a lot more, particularly through the pools, of appointing engagement providers to really have specialist engagement with the underlying companies, measure the progress, how a company's coming back, and ultimately if they're not taking any action, then maybe it is right to divest at that point.
Interesting. To change tack slightly, I know that there's a topic that's probably close to your heart, to the pool's heart, and actually to most of our listeners, and that is the LGPS has received quite a bit of attention recently from the Chancellor, and it was the centre of November's news stories, I think it's fair to say, with this emphasis during the Mansion House speech about beefing up the pools and making them more influential and more powerful. Can you tell us how that's been received amongst the LGPS clients that you talk to? Is it going down well or badly?
Good question. So I spend vast majority of my time talking about this at the minute, and I'd say there's probably a few key themes coming out of the discussion I've had with LGPS funds. I don't speak for all. I know there are some that are very pleased with the proposals, wanted them to go further even. But for most, the reaction's been pretty colourful. I think there wasn't great surprise at the general direction of travel. A lot of this was trailed in the 2023 consultation, though a lot of those proposals were only rejected in the feedback. But I think where the challenges are is really in the detail on this. So I think the first challenge is the pace of change. A lot of funds are uncomfortable with this. By the 31st of March 26, pools are expected to have delivered an absolutely humongous expansion of their roles, which just isn't deliverable. But ultimately, it puts the current day job of pools, which is the highly important role of managing their partner funds' assets and getting their returns, at risk due to the distraction this will cause. By that date, they will need to be able to take in well over £100 billion of assets, be able to advise on investment strategy, implement those strategies with full discretion, and provide due diligence and management of local investments. I think there's been a lot of concern around the ability of pools to take on such services. A competency point. It's not a criticism of pools. It's just the fact that in the vast majority of cases, the pools have not provided these roles before. They're relatively young entities, yet suddenly they're going to be managing with a huge amount of responsibility £400 billion of assets. Quite a few challenges on conflicts of interest as well. A single entity advising you on strategy, fully implementing that, reporting their own performance, probably exacerbated by the fact that funds can't leave their pools if it doesn't go right, if they're not impressed with what they're seeing. And probably the strongest concern linked to that is the oversight piece. We discussed this in a note that we published on Friday. Funds will find themselves with a relatively young investment management company in the pool that's never provided these services before, suddenly having this humongous impact on their investment outcomes. And this means proper oversight to make sure things are being done correctly, find any issues before they become major problems is imperative, especially when you don't have the luxury of moving pools. But it looks like government really want to limit this oversight role just specifically to independent advisors. And there are many extremely knowledgeable, really well experienced independent advisors out there, but proper oversight of these pools takes significant resource that a single person just can't provide. And I've spoken to a lot of independent advisors about this, and they fully accept that they can't do a proper job on this. And I think that's something government really needs to think carefully about in all of this.
To play devil's advocate, Iain, you could argue that you at Hymans Robertson, with a big LGPS investment business, it's not in your favour to allow the pools to all become consolidated and for the pools to effectively act like fiduciary managers and to take a lot of the asset allocation choice out of the hands of the partner funds. So how would you rebut that criticism that people can make?
I think it's absolutely fair. But I think, so we've been clear that we believe pooling is right when it's in the best interest of funds. And ultimately, I think the big overarching theme and cause behind this new expansion of the pools isn't to be in the fund's best interest necessarily. I think it's government ultimately trying to get greater investment into UK. So if pooling is absolutely the best thing to do, then fine, investment consultants cannot stand in the way of that, and funds won't stand for it if they do. But if it is that the funds are not particularly happy with the ideas, there's a lot of challenges to it, because ultimately it's coming from a position of benefiting government and their own growth agenda rather than the best interest of the funds and their employers and their members. Then I think it's right that funds, investment consultants, other service providers, whoever it is, stand up against it and point out the challenges of it.
Yeah, I mean, I think part of the problem, I think, is it was never clearly defined enough at the beginning when pooling was proposed. So we did end up with almost 8 different models for 8 different pools, with some very sort of hands-off attitudes to like very heavily, hand the whole lot over to us and we will manage it all for you. I mean, as a journalist who's written about this a lot, I have to say that I can see both sides of the argument. I can see the benefit of consolidation. I can see the benefit of the pools really acting as a professional organisation, and I can see that would actually benefit the partner funds, because it could free up their time to focus on bigger, more important investment goals and strategic decisions they need to make, and even spend more time thinking about, to go back to what we were talking about at the beginning, about sustainability. So I think there are definite advantages to the partner funds, but maybe it's how you implement it and how long a time period you have to do it that's the issue.
That's exactly right. And I mean, one pool did have a lot of these actions in their business plan, but for 2030, not for 2026. And even they are saying this is going to be a tall order for us. So I think there's a big implementation risk here, and it should maybe not be allowed to happen naturally. Maybe it does need a bit of a push, given that pooling's been going on since 2015. But I don't think just coming in with a hammer to crack a nut, there's just absolutely no need to go this hard this quickly. I think it could be a lot more successful and go a lot easier if they just listened a little bit more and maybe slowed it down a bit.
The government listened to business and reach out to people. What a crazy idea. So I mentioned sustainability there. Is one of the concerns for the pools when it comes to sustainability is they're very aware of their role as local providers, not just of the services that they exist to provide to local communities, but that they also want to have a local investment strategy. Is that something that pooling could challenge, or are people starting to think about ways around that and how to keep that local flavour to investments?
So it's really interesting. So the way government wants it to work is that funds work with local bodies like combined authorities, mayors, to find investment needs and opportunities in the local areas, and they then pass this through to the pools, who then do the due diligence and decide whether to invest. So it's quite similar actually to taking the Greater Manchester Pension Funds approach, but take it into a pool. It sounds great in practice, but it is really difficult. And actually, maybe by doing it through the pools creates a degree of separation that Greater Manchester don't have, because they can work with their own combined authority. But I think the feedback from the 2023 consultation for many was we just don't have the capacity to consider these sorts of investments. They're a lot more intensive to consider. So government's idea is instead pools take that on. They build out the teams and the resources to do that for the funds. But actually it's going to be a very new task for pools with extremely limited experience, I'd say, in the industry to buy in or to learn from. So ultimately, the risk here is that if investments aren't assessed or managed properly, they can lead to both poor performance, but also potentially you could have negative impacts on funds' local areas, which is the opposite of what anyone wants. I think there's an additional challenge that these local bodies like combined authorities or mayoral authorities are also only just being set up in many places, so they won't be able to be productive and find these opportunities for a couple of years at least. So I do think this will take a long time to come to fruition, but ultimately that's fine, that's good. Funds and pools should be given time to do this. They shouldn't be forced to pump money into local areas if they're not ready for it and the investment opportunities aren't there. This is an urgent issue for government. Likely by the next election, they want to be able to point to lots of wonderful investments that have been made and take the credit for that. But the priority instead needs to be on the LGPS. One, getting the required returns from these. Two, making sure local areas are not negatively impacted by rushed investments. I think that is a key concern I hear on this point.
I mean, it's interesting, isn't it? Because you kind of see it, you have a contradiction there where, as you said, and I don't think it's just the LGPS that feels this, that the government's agenda to sort of boost growth by getting pension schemes to invest in the UK has landed with differing reactions, I think it's fair to say, across the industry. And so that's kind of like, on the one hand, that people want to be not pushed into doing something that they don't think is in their members' interest. But at the same time, local authorities and their pension schemes are motivated to invest locally and keep that local connection. So that can be a bit of a contradictory situation, can't it?
Yes, exactly. And I think there's probably a lot of motivated people in the LGPS that would happily invest in the local areas and create that positive impact. I just think what they really need to make sure is it is paced out suitably and the money isn't rushed in. Greater Manchester Pension Fund have had a lot of success in what they do, but they were from a starting point of investing in Manchester, where there's lots and lots of opportunities, already a developed area. But also over time, they've done it. So they've created positive economic growth from their investments that's then created more opportunities from that. So over time, they've slowly been able to build up that. But instead, if they'd just gone in with their full 5% of their assets in one go, it probably wouldn't have got the returns they've got. And there probably would have been a lot of negative impact on local areas. So, it really needs to be carefully thought out again. And it's the pace of it. We don't want this rushed because of a government agenda.
A Greater Manchester Pension Fund is a very big pension fund in its own right, isn't it? It's one of the biggest, if I have that correctly.
Yeah, they are the biggest. They're over £30 billion. So they have the internal resources to have a team to do this in-house, something many LGPS funds don't, which is why they kind of want to build that capability at the pools. But I really think the huge amount of value Greater Manchester have is the strong connection the team have with those local bodies like the Mayor, like the Combined Authority, to do that could be lost.
Yeah, I mean, there was a piece I saw in the FT, and I can't remember his name, so apologies to listeners for that. But there was a councillor who was very influential in the regeneration of Manchester over many, many decades. So that is very much a story of a local authority and its pension fund working together in a positive benefit for a local community, isn't it?
Yes, exactly right.
That particular magic can be difficult to recreate if you have one person who is particularly visionary.
Yes, exactly. It is a very difficult thing to replicate, and I know other pension funds have looked into replicating it and I've found it very difficult because of local workings or whatever it may be. So I really don't think this is an easy task. And to be honest, when I speak to pools, this is maybe their biggest concern at delivering on this growth agenda.
So you're saying that the concerns are not just coming from the partner funds, which you could sort of understand from a psychological perspective, that a lot of their control would be effectively ripped away from them, but it's also coming from the pools who just don't feel ready to step into this role yet either.
Yes, I mean, I can't speak for every fund, I can't speak for every pool, but a lot of the conversations I've had with pools have been, generally we think this is the right direction to move in, but in these timescales, it's just not deliverable and there's big concerns about it.
Interesting. Well, I think that's a great point for us to end this discussion. Thank you, Iain, for sharing your news story and all your insights and such a fascinating discussion and giving us an idea from the coalface of what it's like talking to partner funds, LGPS pools and their reaction to the Chancellor, as well as this ongoing issue of how to invest sustainably. Big thanks to you for being my last guest on this particular series. I've tried to be as Christmas as I can. We've got sequins, we've got Christmas trees. Iain, unfortunately, failed miserably and did not put Merry Christmas in big sequins behind his head, but we'll forgive him for that. Thank you, all of you, for listening. If you want to make sure you never miss a future episode of the podcast, then make sure you hit the subscribe button and don't hesitate to get in touch with me if there's anybody you would like to see and hear on the podcast. Thanks for listening.